This is a podcast from the Business Times.
The Nasdaq closed lower yesterday, dragged down by losses in big tech shares, while the S&P closed near flat and the Dow closed higher as investors digested new economic data. Tech shares reversed early gains to move lower, weighing on the Nasdaq. Global stocks rose, though, as strong earnings from chip makers lifted sentiment, although investors remained wary about stretched valuations for AI-related shares, while the dollar hovered near a one-year high. The yen, however, wobbled near its weakest level against the dollar in 40 years early in Asia trade, and central bank officials sent mixed signals about the policy path ahead. Welcome back to Market Focus Weekly. I'm Howie Lim. It's Friday, June 26, 2026. I'm joined by Aninda Mitra, Head of Asia Macro and Investment Strategy at BNY Investments. How are you doing, Aninda?
I'm good, Howie. Thank you for having me.
Always a pleasure. I want to start with the AI valuation paradox, though. We saw a historic 10% plunge in Korea, followed by a massive rally as chipmakers added $400 billion in value. Do you think we're witnessing a healthy rotation or maybe the beginning of a structural decoupling between the AI hype and actual earnings delivery?
I think it's too early to call it decoupling. There are doubts, obviously, which crop up from time to time, and we've seen this with individual stocks as well, which have gone up a lot and then sold off only to make a very strong rebound. The reason we are still quite constructive on AI and its earnings delivery capability is because the demand is still there. I mean, since you brought up Korea, a simple way to frame this demand for Korean chips is to look at its exports and production every single month and map that against global manufacturing PMIs or orders to shipments ratios. And those still look extremely strong. So the demand clearly is out there and supply is limited. And if you view this from a very long-term history, typically prices of chips have always declined. The Moore's law effect has been to increase processing power and reduce costs, except we saw a small exception to it, 2021, when COVID caused a spike in demand for work from home and online conferencing and so on and so forth. But this time around, since 2024, we've seen a massive rebound in chip prices, and I think that reflects an abundance of demand rather than hype. Long story short, we're still constructive on the delivery of the story continuing to, reap rewards for investors.
Speaking of massive rebound, the Kospi did do that, but then it also experienced its sharpest drop in months before that happened. What's the biggest hidden risk then in the market right now that retail investors are ignoring?
Well, there is an element of circularity, clearly, with several buyers looping into each other's capabilities and product spaces. So it has become a race to boost your capex, to beat the competition. And there is indeed a risk of misallocation of resources or being undercut by a cheaper, better model somewhere else. So that's the competitive dynamic which poses a risk in a landscape, in an industry which is changing very rapidly. So, if you will, another DeepSeek moment could always be out there lurking and posing a fundamental risk to a lot of capex heavy stories out there. So that is the risk of a churn more broadly in the industry. So we're certainly not recommending taking concentrated bets, but since you asked me about the state of the broader industry, we do remain constructive on this whilst recognizing the competitive risks that are bubbling up.
Earlier, you talked about the strength of the Korean chip sector. We've, however, seen a dramatic reordering of that sector as high bandwidth memory demand reshapes the hierarchy of leading producers. Do you think this shift represents a permanent change in the memory chip industry, or is the current market dominance merely a byproduct of the AI-specific cycle?
Yeah, that's a tough one to answer because my temptation would be to say this dominance is going to last for a while, but eventually high prices tend to attract more investment into the space and more competition eventually. But given the starting point of a handful of producers in Korea and Taiwan, we do think that this dominance is set to last for a while. This is not an easy sector to break into very rapidly. So I hate to call this a permanent shift, but we do think competition to intensify in the space and challenge the dominance of existing incumbents, it's not going to be an overnight thing. So it will take a little bit of time, but the threat is on the end user side in terms of the nature of AI intensity and chip intensity. Could that change? Should a better, cheaper, faster model come around from somewhere else? And that may drive some shifts in upstream demand as well. But for what it's worth, the Koreans and Taiwanese producers on the memory side and the processing side continue to maintain a very firm hold on the upstream supply of the stuff. And challenging this dominance is not going to happen overnight. It will take a little bit of time, but don't rule it out altogether either.
What about corporate capital deployment trends, Aninda? Large cap tech players are increasingly seeking massive offshore loans and utilizing secondary listings to fuel growth. Do you think we're seeing signs of a corporate liquidity crunch, or is this simply a reflection of aggressive capital deployment to stay competitive because of this AI arms race?
Yeah, no, yeah, you're absolutely right. I think it's a very big shift to have large tech companies, a Max 7, and even beyond those usual names that you're familiar with, to go from being large cash generators to being cash consumers, right? So that does drive some tightness in corporate liquidity. It could quickly turn sentiment should earnings disappointments or free cash flow disappointments start to come through more palpably. It's not our base case for those to happen at a large scale. They could be individual disappointments here and there. Again, most of it is going to be competitively led, but that is a risk, and it comes amidst a tightening of monetary policy and so on. And we've seen a bit of a shakeout in the private credit industry to some extent, which was taking off a lot of pressure from public markets where issuance in both investment grade as well as high yield was taken off on the private side. So, yeah, there are some signs of tightness. Some caution is definitely warranted. There are cross asset implications amidst a tightening policy cycle as well. So, it's something we are watching closely. This is not just a blank check. Hey, it's party time. AI is going to save everybody's portfolios. That's not the case at all. So we are selective in terms of how we view credit, and we do recommend it being quite well diversified when you're looking at growth companies. And in a higher inflationary environment, there's also something to be said for having an allocation towards value, which tends to do a little bit better insofar as inflation remains above trend and the Fed struggling to get it under control.
All right. Should we talk about oil, or is that like a waste of saliva at this point? Is it done and dusted thing?
Well, it does seem that way, but I think it's still important to cover oil because it's such an important part, such an important input into economic growth.
Okay, let's do that in a bit. We have to go for a break. Stay with us. More with Aninda Mitra from BNY in a moment.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. All right. Why is it important that we still talk about oil right now,
Yeah.
Aninda?
Yeah, so look, it's an important ingredient. There were concerns just a few months ago about physical shortages across many countries in Asia Pacific, which ultimately did not materialize for a number of reasons. But even so, it does remain not only a source of risk, given that the flows from the Persian Gulf have not fully materialized, but at the same time, given the alternatives which have come up in terms of the focus on renewables, the ramp up in production from the US and from Brazil and Venezuela and so on, and from other Central Asian republics, we could at some point even be facing the prospect of a glut. The UAE is leaving OPEC because it wants to produce more than its usual quota. Iran's probably going to be doing the same thing. So, it's important counterintuitively for the opposite reason. We could actually be seeing a glut of oil in 3 to 6 months' time, and it could even pull inflation lower than what is priced in at the moment. So that's the reason why I wanted to bring this up and just lay the case out there that we could be looking at much lower oil prices than what even the futures curve may be pricing in at the moment.
Oh, so you folks, market watchers, are not fearful of the durability of the peace talks? the peace trade rather, and that
Yeah.
crude prices will stay there. We won't sort of need to prepare for a supply shock that could send Brent back to over 100.
Yeah, the fact that we have at least some sort of a rubric of an agreement to begin with highlights that both sides do want an end to hostilities, at least kinetic hostilities across the region. But having said that, there are deep differences on a host of other topics, be it nuclear enrichment and so on, and support for regional proxies, be it further out in the Middle East. So, yes, there is a risk that this deal could unravel, but will it disrupt oil supplies to the extent that it did earlier back this year in March is questionable. So we're not completely ruling out those risks, but again, because of the glut with other producers stepping up and importing countries boosting their own energy efficiency and focusing increasingly on renewables, we don't think this will pose a fundamentally huge risk down the road. But never say never. There is the prospect of Trump revisiting the deal after the midterms. That's an argument that I've heard quite often from political analysts. Once that is out of the way, he could take a more hardline stance vis-a-vis Iran. One needs to watch the outcomes of the midterm elections in the US and what happens geopolitically around the world after that event is behind us.
Same question about gold. Should we be talking about gold? Is there a need to? It
Yeah.
slid below 4,000. That's a psychological threshold.
Yeah, so gold has been the big disappointment, especially since the breakout of the Iran conflict. Look, it did extremely well when we had recommended longs on gold through much of last year. There was the debasement trade underway, and the concern there was twofold. One is, or was, that the Fed's independence was being undermined by the Trump administration. And that brought back memories of the Arthur Burns episode when the Fed was chronically behind the curve and inflation expectations picked up quite a bit. And this time around, indeed, since the end of COVID, US inflation hasn't gone back to target. It's chronically been above 2%, not massively so, but still hovered above 2% for quite a while. And last year, if you recall, there were serious concerns about the Lisa Cook affair and Trump's direct challenges to Fed Chair Powell's authority. So those alongside above target inflation was raising the prospect of interference with the Fed's independence and which would ultimately undermine its inflation tackling abilities. And the second driver was further back in 2022 when Russia's reserves were confiscated by US and European authorities. That resulted in a pullback by central banks worldwide and at least some attention to finding other stores of value, other backing for their own reserves and so on. So those two drivers were big factors in pushing up gold prices. And then the retail investors piled onto the trade through much of last year. And that argument has come off quite significantly. I mean, the real rates in the US have risen quite a bit so far in the year to date, with inflation pricing, at least if you look at the break-even market, inflation pricing beginning to come off. And Kevin Warsh has, I think, been at least initially successful in reassuring the markets about his inflation fighting credentials. So all of that has, I think, fed into a weaker outlook for gold prices. So this is not an asset class that we are banking on making a huge rebound, unless, of course, there's renewed interference by the Trump administration with the way the Fed operates. But that is not in evidence so far.
But you can't rule it out, right? It is Trump.
You can't totally rule it out. That is, you're right. If it does come back, then we could revisit the case for gold. And if there's additional geopolitical concerns about the trade conflict and which countries could be in the crosshairs of the Trump administration and what that implies for their reserve holdings in US dollar terms and so on. So those could be issues which could make a comeback. Those are conceivable risks, but it doesn't seem like a hugely plausible headwind just yet.
Speaking of political, maybe not geopolitical per se, the UK's Prime Minister, Keir Starmer, resigned, but it barely created a ripple in global markets. What do you make of that?
Yeah, I think this is a bit more chronic in the UK, where you've had weak governments, fractious governments, and frequent changes of prime ministers.
Yeah, I
Does it? Does
saw
it?
a funny meme where Larry, the cat in residence at 10 Downing, is the longest serving member of the UK government.
Yeah. So, I mean, to the extent that Larry can affect changes in fiscal policy in the UK, which seems unlikely, the markets will pay more attention to what happens with fiscal settings out of 10 Downing Street rather than, who's really saying what at the lectern outside 10 Downing Street. And so far, at least, look, UK gilt yields are pretty high. They're higher than almost any other developed market that I can think of, even higher than US yields or Aussie government bond yields. So a lot of the uncertainty is already priced in, I would say, and that could be one of the reasons why we haven't seen much of a ripple in global markets from developments emanating from the UK.
I wish we had more time. Aninda Mitra, Head of Asia Macro and Investment Strategy at BNY Investments. Thank you for speaking with us today.
Thank you for having me again.
That's it for this week's Market Focus Weekly. If you have questions or feedback, drop us a note at btpodcasts@sph.com.sg. Till next Friday, I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.